Welcome back, wealthies, to another episode of All the Wealth. If you've been watching markets this year, you know the question that's been on everyone's mind lately is will they or won't they? 25 basis points, 50 basis points. We're talking about the Federal Reserve today. Now we have our answer because this week the Fed cut rates by a quarter point. It's been the first move they have done in over 9 months. They also signaled in their meeting that more cuts are likely coming. So today we just wanted to unpack what that kind of means for you, what that means for your investments, and what we should expect in the road ahead for the rest of the year. Let's look at what the Fed just did. So the Federal Open Market Committee, that's the group of smart people that make decisions on interest rates for the US economy. They voted 11-1 to lower the benchmark interest rate to a range of 4.25%. That's the lowest rate we've seen in about 3 years. So a little background, the Fed has a dual mandate for what they're trying to do with the economy. They want to control employment levels, and they want to make sure inflation doesn't run too high or below their 2% inflation target. Lowering the rates, at this stage does make sense. The Fed is worried about cracks we've seen in the labor market this year. Jobs have slowed quite sharply. In the beginning of the year, we were averaging about 150,000 new jobs per month. In the last 3 months, we've seen about 29,000, so a pretty significant drop. The unemployment rate has also gone up to about 4.3%, as opposed to the 4 to 4.2% we've seen for over a year. As Chair Jerome Powell said kind of plainly, the downside risk is a reality. What he means by that is you don't want to keep rates too high in a labor market like this. It could put undue pressure on what they're trying to accomplish. Not everyone agreed. From the meeting there, you saw the 11-1 vote. Stephen Miron, which is the newest Fed governor, he wanted a bigger half a point cut. So he thought, better for the Fed to get ahead and shore up growth. We'll see. The split has been pretty politicized this year. It kind of shows how divided a lot of policymakers have been. Some fear that cutting too slowly will risk a bigger and deeper job slump, and others fear that cutting too fast could let inflation run hot again, which is an issue that we're all pretty familiar with at this point. We want to talk about why this is important for you as an investor. Or even just as a person who has debt or spends a lot of their time trying to budget and do these things, borrowing costs are going to drop a little bit. So if you've got credit card debt, which, we never recommend having too much credit card debt, but if you have some, or an adjustable mortgage rate, or a small business loan, or anything that's tied floating to a short-term rate, your payments are going to edge a bit lower. It's like a little bit of a smaller monthly bill for you. It's not going to be a huge windfall or anything like that, but it will be noticeable. If you've got mortgages or longer-term loans, you're not going to see quite as big of an effect right away. Long-term rates don't move one for one with every Fed move, but markets do anticipate that future cuts are coming. So that's already nudged down some of those longer term yields, which means longer term mortgages should reduce as well. If you're refinancing or house hunting, this is good news for you if you want to take on some debt. For savings accounts, it's the opposite. So if you're a little bit later in your investing journey and you've been counting on these risk-free rates of about 5%, we're going to start seeing those slip into the 4s, maybe down to the 3s after the end of this year. So you're still going to get more than that pre-2022 levels, but cash isn't going to pay quite as nicely after today and likely over the next couple of Fed meetings too. So the takeaway is that, for borrowers, lower rates are going to help you. For savers, it means you need to think about maybe more than cash, especially in your longer term plan, whereas it's been a decent asset class for the last couple of years. Markets are paying attention to this. Let's talk about some stocks, and just remember that, the stock market is not the economy. So the correlation between the two is actually less than what people think. And in certain times, the correlation between the economy and the stock market is actually negative. So it can be a leading indicator, but timing and things like that, it's not always clear. The markets move on expectations, not just headlines. So if everyone expects terrible news, but the reality is just bad, stocks can still do well. So you might sometimes hear that bad news can be good news can be good, and good news can be bad. So just keep that in mind. Right now, the last few days, we've seen some relief from investors. Stocks have been pretty green since the announcement that the Fed cut rates, and that more rates are likely coming in the next in October and December. Lower rates are generally supportive for equities, especially growth stocks like tech stocks, because you get a lower discount rate. There's some boring math in that, but at the end of the day, it means that lower rates good for stocks. There is a catch, of course. It's never always that simple. Inflation has been sticky. Core inflation rose from 2.6% in April to 2.9% in July. So the whole reason the Fed raised rates so significantly and so quickly in 2022 was because of high inflation. So if inflation stays hot, the Fed might not be able to deliver on all those expected cuts. So that could trip up the markets. A risk that you want to pay attention to going into the end of the year. And for a little historical context on this, it's not the first time the Fed's been kind of caught between a slowing job market and stubborn inflation. We saw this in the early 2000s after the dot-com bubble. The Fed cut aggressively to cushion the economy after a pretty big shock. And then later during the financial crisis in 2008, same thing, they took rates all the way down to zero. The big difference today versus those two time periods is that inflation is actually still above that 2% target that they're aiming for. And we have these tariffs that we didn't have in those two periods. It's adding a bit of fuel to the fire, making it a little bit harder for the Fed to move rates down too quickly. This moment looks a lot less like 2008. It looks more like the mid 90s or even 2019, more like a mid-cycle adjustment to prevent the softening economy from going into what that big R word we were trying to avoid slipping into a recession. The last thing as well is the political drama has been unavoidable for the Fed in the last few months. When you have the president of the United States tweeting at you, it's going to affect you as much as he says it doesn't. I don't buy it, but it is what it is. For investors, what it means is there's going to be a lot of noise to the end. Expect some more tweets, expect all these types of things, but stay focused on the fundamentals, stay focused on your longer term plan, and it'll be okay. So just to wrap it up, what does it mean for you? Borrowers, you get some modest relief. We get some more Fed cuts probably this year. For savers, your yields are probably going to drop a little bit. Diversification is more important now than ever before. And for investors, markets are forward looking. So don't focus so much on the headlines. Focus on whether the news is better or worse than expected. But again, keep with your long-term plan and speak with your advisor if you need to, if you have big life changes, things like that. This quarter point move was really heard around the world, at least in the finance world, but it's just the first step. We'll see what the data does. We'll keep our eyes on October and December, just like everyone else, and just stay tuned. And then, as always, we're going to be here to break it down for you and translate it into as plain English as we can for your money and your plans. So again, reach out to your advisor if you have some questions, and we'll see you next time. Thanks.